We're gonna be talking. Hey, welcome to the Closing Beat, everybody. Happy Tuesday. It's not Monday, it's Tuesday out there. How you doing? Hope all is good with you. Hope you had a good long weekend there and ready to get back to the markets, even though it doesn't seem like there's anything that we should be getting back to, man. We all just take one more day off, let the markets think about what they want to do. And, we'll see how it goes, right? Come back tomorrow. That's it. We'll just wrap it up. Hey, we're financial advisors here at Jazz Wealth, and we like to talk about the stock market. We're here every day. We're not active day traders and things, but we like to talk about the stock markets. We're going to dive right into this here today. I did something interesting, which really, if you're a client, you might want to check out. Every week I do this Notes from Jazz thing. I want to point something out to you guys here, right here. And I'll make it bigger and move it out of the way so you can see. This is officially the worst year on record for those of you that have a 60-40 portfolio, 60% stocks, 40% bonds, aggregate bonds. You can see the performance there. We had a little fun with it, right? So you're down 14%. That's the worst on record. And that's because bonds are so heavily correlated to stocks right now. It's impressive. There's over a 50% correlation in bonds including today, the last 132 days. That's the longest streak ever, right? So bonds moving lower, the price of bonds moving lower with stocks. That just doesn't normally happen. So if you have any, percentage of bonds in your allocations, like in your 401ks, or this could be a target date fund, right? You could have maybe a 2030, 2035 target date fund, something like that. You're feeling the pain there because of the bond positions as well. So really, really odd. And I went a little further. If you want to check it out, if you're a client or research member, you can go in there. I went a little further to go, what if we had a crystal ball and you could actually have chosen to do 33% stocks, 33% bonds, 33% commodities, right? Because we have oil helping us out there. So we're just playing around with some different ideas. Then I even went further and said, well, what happens if you just did that all the time, right? This year sucked, but what happens if you always did that? So be sure to check that out. And I really wanted to point that out to all of you, that if you have target date funds in your 401ks and maybe you have the life cycle fund in your TSP, yeah, it's a problem. It's a problem this year, and that's for sure there. Another thing that's a problem today is the stock market. Let's take a look over. Well, you see on the right-hand side of your screen, Dow down another 0.5%, S&P basically down 0.5%, NASDAQ and Russell 2000 down. Pretty tough there, and it's a shortened week. Remember, yesterday the markets was closed. It tends to be a rough one, if you're curious. Had a little fun with this one. So the market behaves in various ways depending on if we were down already or if it's a strong year, right? So I always like to break it down that way, kind of to show you the data there. What happens if the shortened Labor Day week, what's the performance when the market is already down? Take a look. So here we go. We've got the performance by day. This today is known to be extremely weak. In other words, the red that you're seeing here is if the market was already down year to date, and then we come into this holiday shortened week. Tuesday, the worst day of all of them. Thankfully, you get a little bounce on Wednesday and then just sort of flatlining the rest of the week. So the Tuesday after, Labor Day, right, tends to be incredibly weak there. And that's exactly what we saw today. Not quite down to the average of what we've seen over, the last 50 years when we look at this, but that's incredible, right? We performed exactly like we were supposed to, almost exactly like we were supposed to. In other words, it's not one of those weeks where you expect a massive rally or some kind of massive comeback there. Add to that, old Biden last week. I didn't catch it on whatever night it was, but I've seen the social media posts and stuff going around. Boy, he was aggressive with the red lights and stuff in the background. Whatever side you're on, all that really means is they've officially kicked off the midterm election season. Right? So politics are going to come playing into the markets again. And that was a matter of time. It was going to happen anyways. We know that that's the case there. The markets in general, no matter where you stand, the markets like to see no change. So it would be great if these guys, they fight and they do whatever, talk about whatever they do. And then the midterms come and go and nothing changed in the House, in the Senate, and of course the presidency, right? So if that's the case, the stock markets really like that. You may not like that, but that's what the market's like. What they don't like is change, right? The Republicans to take over, to actually have control of the House and the Senate, they don't like that, right? They wouldn't like if Democrats controlled everything, right? We don't like to see one side having control. Historically, I've done classes for this for clients to show that the stock market actually likes status quo. It gives us a chance to just put that off to the side, let our emotions get calmed down there, and get back to fundamentals. So be on the lookout for that. The stock market betting odds actually have the Democrats taking a little